Today, in less than 5 minutes, I'm showing how much UiPath stock is truly worth by using the most accurate method to value a company, the discounted cash flows. The DCF shows how much are future cash flows worth today by discounting them using the company's weighted average cost of capital. Let's start our valuation with the most important input, the revenue estimates. For the revenue estimates, I used two growth periods. Firstly, a 5-year intense growth phase, followed by a second phase of 10 years of maturity. For the first 2 years, I used the revenue estimates posted by the Wall Street analysts, and then for the following years, I based my assumptions on the growth rate expected for the industry. Here I have the RPA market and the compounded annual growth rate for the market estimated by several research companies. Here we have a mean of around 29% and a median of around 27.7%. So I'm going to be using this as my input, but I will be using a slightly lower estimate for the revenue growth in the base case, since I assume that UiPath will be losing some of its market share due to new entrants in the market. Going to the terminal year, I estimated a terminal growth rate of 3.5%, and I have calculated here the compounded annual growth rate for the period between 2022 and 2037, which is around 14%. So this is below what the market is expected to grow, so I would say that these are some really conservative assumptions. Next, I have the operating income excluding the stock-based compensation, since I believe it is easier to model the stock-based compensation separately. Based on the first 9 months of 2022, I have a adjusted operating margin of around 3% for the financial year 2023. Next, I use a terminal year operating margin based on the assumptions guided by the management. If we use the mid-range for the guidance offered by management, we get a 28% terminal year operating margin, and I have assumed that the operating margin will converge from 4% to around 28%. Next, we have the elements that are impacting the cash flows. Since it is a software company, it doesn't require massive amounts of investments, so I have modeled between 1 and 3% for the long term for these elements. One very important aspect is the stock-based compensation. This is generally an important way of financing for software companies, and so this input is truly important. For financial year 2023, I have used the first 9 months of 2022 as a guidance, and for the next 3 years, I have estimated that the stock-based compensation will remain a high expense for UiPath. After these years, the company's stock-based compensation as percentage of revenue will converge towards an 8% terminal value that is based on the median for software stocks. This next element is truly crucial, and it shows the real free cash flow that UiPath will be generating, and as you can see here, it will become positive in financial year 2027, so that's in 2026. That will be the first year when UiPath will generate true free cash flow. The last input for the DC evaluation is the discount rate. This is a weighted average cost of capital, and I have used two values. Firstly, for the present, for the first 5 years where the company grows intensely, and then for the maturity stage where we should apply a lower weighted average cost of capital. Based on companies like IBM, Google, or Microsoft, I have come to a 15.5 weighted average cost of capital for the first phase and a 7.5 for the mature state. Here's the summary of the analysis. We have two ways of estimating the terminal value, the perpetual growth method and the multiples method. The perpetual growth method is truly the best way to value a company, since it only relies on the free cash flows of the company. As I assumed a terminal growth rate for the free cash flows for 2.5% on the base case, and based on that we have a price target of $19. For the multiples method, I assumed a 13.6 EBITDA multiple for the terminal value based on the multiple of Oracle, and I have come to a price target of $19. To sum up the two valuations method, I get a $19 target price, and that's a 32% discount to the market price. However, since I don't own a crystal ball and I can't tell exactly which inputs are perfect for valuing UiPath stock, here is a range of values where I believe that the true intrinsic value of company is situated. Based on the terminal weighted average cost of capital and the terminal growth rate and EBITDA multiple, I believe that the true intrinsic value of UiPath is somewhere between these values. To sum up, even if a company seems undervalued, please note that we are finding ourselves in a difficult macroeconomic environment where companies can remain below their intrinsic value for longer periods of time. So before investing, please carefully consider the risks involved with investing in UiPath stock. Next up, I'll be posting a complete financial analysis of UiPath stock. Until next time, keep crushing it and subscribe.